Okay, we're live. Good morning, everybody. Good morning, panelists. How are you doing? I'm Peter Ingersoll. I'm the moderator of this panel today regarding cannabis and commercial real estate. I'm the CEO of Safe Harbor Equity and the founder of Rescue Capital Group. We provide a wide range of capital solutions for cannabis operators. As the name implies, we're focused on those operators who need the capital most without being predatory. A little personal history about me. I was drawn into the cannabis sector because it saved my wife's life. God bless cannabinoids. This webinar series, would not be possible without the support of Zuber Lawler and their dedicated staff and fantastic team of attorneys. Big thank you to Tom Zuber, the managing partner. Zuber Lawler has some of the best and brightest minds in their respective fields. Zuber Lawler is a global company with a traditional base of Fortune clients, yet they remain clear-eyed futurists in emerging industries such as cannabis, psychedelics, clean tech, cryptocurrency, and artificial intelligence, just to name a few. To learn more, please see the link in the chat, which our trustee administrator, Anthony, will put in here shortly. Our intent today and every day is to help cannabis companies successfully navigate today's challenging business environment. Today, we're going to discuss how a cannabis operator can manage one of the largest expense categories for their companies, their respective real estate costs. And we want to thank you, the audience, for attending today's panel, and your feedback is very important. Before we start, we'd like to send you a 6-question survey about your needs and your perspective, and we'd very much appreciate if you took a moment to answer that. Your feedback is truly vital for this series. I'll give that a second so you can take a look. Our thesis today is simple. Long-term control of real estate supports stability, but at what cost? We will explore this question in a moment, but first, a disclaimer. The opinions expressed are the opinions of the individuals, not the companies associated with this webcast. We don't encourage the use of illegal drugs. Consult your healthcare provider and attorney regarding the use of cannabis. Nothing in this presentation creates an attorney or fiduciary relationship. Please seek the advice of your own professionals. And as you can see, we just posted that same disclaimer in the chat just to protect ourselves. Now, let me quickly introduce the panel, starting with the one and only Janet Jackham of Zuber Lawler. Janet is considered one of the best attorneys in America, according to her peers. Her friends and colleagues have even higher opinion of Janet. Janet is the co-chair of the 30-attorney cannabis practice group within Zuber Lawler. She has handled countless transactions with numerous corporate clients, cannabis MSOs, and small operators. Janet, welcome again. Thank you. Would you mind give us a couple highlights of your most interesting cannabis real estate deals, and how did you end up representing so many cannabis clients?
Funny you should ask. Actually, Brian and I at Brian's company and I were recently involved in a transaction. I'm going to take some editorial liberty with the facts. But I've been practicing commercial real estate for 45 years and 10 years with it primarily in cannabis. And I can't quite say that I've had such a great opportunity in representing the landlords in maybe the perfect lease transaction. Great location, pardon me. Great location, great, as they say, location. Lots of landlord stops and obstacles to be put in the tenant's way. And I do represent tenants. I like them too. But for example, this landlord does not permit assignments of any nature without its consent. This is a marijuana premiumed market rate, a great guarantor, and other pro-landlord provisions were negotiated. It was a good opportunity for these investors. the reason I got, or how I got into it, honestly, is related to the Christian Chaldean community in Arizona. These are people whose ancestors lived in Iraq, and they moved to the States. And these are they're the quintessential entrepreneurs, and they wanted to get into cannabis, and now they're quite prevalent in owning and operating cannabis dispensaries and cultivations across the country.
Highly active in Michigan as well. Well, thank you, Janet.
They are.
Next up is Brian McLaren. Brian is the founder, chairman, and CEO of Zone Properties, a leader in the cannabis sector. As a public company, Zone Properties provides capital and commercial real estate services. Its ticker symbol is ZDPY. Brian, welcome to the panel today, and thank you. And again, tell us a little bit about how you got into the cannabis sector and why do you focus on retail?
Yeah, thank you, Peter, and great to be here. Always excited to chat about this. This hour will go by fast. So my quick background, I come from a equally grassroots movement type of sector. That's one of the greatest things about cannabis, built over decades from amazing legacy operators that have brought us to this discussion today, right? So my background pre-cannabis was sustainable and community development. Similarly, lots of grassroots movement, the environmental movement, but really what it's all about is creating more prosperity in our communities. And so I always viewed the best opportunity to do that, whether it's sustainable development or cannabis projects, through the built environment. Our communities are organized by long-term master plans. They are built by real estate and property development, which impacts all of us in the community. And lots of opportunity for entrepreneurialism, building value. And my go-to for this industry is be kind to others, be kind to yourself, and that's where the most value gets created. So thanks for having me.
Well, that's great. Thank you. I mean, I did not know that myself, so I appreciate that very much. Up next is Robert Kerr. Robert is a correspondent banker with his company Echo Capital. He's the founder 7 years ago, I think, Robert. Echo Capital has over 300 plus funding partners. Robert completes his own internal underwriting issues funding commitments within 72 hours of completing that underwriting. His current team consists of 10 associates, and a network of over 2,000 brokers. So Robert's kind of same question. Welcome to the panel. Good morning. And give us some of your career highlights. And also, I'm curious, how did you end up in cannabis?
Thank you so much. Yes, I'm definitely looking forward to the panel today. Brian did say yes to his point. I love talking about this topic. How I personally got into it, I used to work for a bank called Opus Bank out of Irvine, California. However, I sat in their Portland, Oregon office. I ran their business banking team. And at Opus Bank, we were getting calls in droves from the state of Oregon and Washington operators who had just become legalized. This is back in 2015, 2016. Seeking depository relationships and lending relationships. At that time, I realized that there was an opportunity to move into an industry that what I would call needed a professional banker. So I left my lucrative job and started up in an investment bank to help cannabis operators do that. For the first 2 years of my industry, I literally did everything for them. So I find that knowing the insides and outsides of the business was very helpful for me in helping these operators be funded. Advanced 7 years later, we've now funded $150 million into this space to date. We have a lot of operators nationwide that we've worked with. On a side note, I'm also a big believer in an alternative use of medicine, and I think cannabis provides that specifically. So that was certainly a secondary reason of why I chose to move into this industry. And to your point on the banks piece of it, we have groups that are allowing us to participate with them. So we have our own wholesale line of credit that we can allow for funding this cannabis industry. In addition to that, we do have banks nationwide that are willing to refinance out our loans upon the bridge process being done. So thank you again for allowing me to be on the panel and looking forward to the questions and answers.
Yeah, appreciate it, Robert. Thank you. Next up is Brad Kenson. He is the managing partner of Roots Properties. Roots Properties is a professional development company that specializes in cannabis cultivation facilities. To date, Roots Properties has developed hundreds of thousands of square feet of cannabis facilities in Southern California for the country's top brands. On a personal note, Brad is a dedicated triathlete. You go, guy. So welcome, Brad. Nice to see you again. And how did you end up in the cannabis construction development business?
Yeah, so I guess long story short or short story long, real estate development's in the blood. Saw the opportunity in 2018, but our entry point was actually through the utility consulting because of like the power requirements of cultivation facilities. So that was our entry point. Fast forward to today, you know, we handle these projects from inception to facility launch, and you know, we really love what we do. We have a great team. And it is unique because we'll handle the projects from the very early stages to facility launch. And, you know, through that process, you really get to know people and build relationships. So I think, you know, the highlight for us is really working with some of the best cannabis entrepreneurs in the space. And it's been really fun tackling, you know, massive challenges with them. And there's always a challenge in this space, right? So we love seeing these things get built and their visions come into life. But for sure, the highlights, you know, the relationships that we built across the board.
Awesome. Well, thanks, Brad. Thanks for being here. Again, to reiterate our theme and our thesis, because cannabis sites are harder to get than traditional commercial real estate because of the zoning laws and the restrictive zoning laws, securing the location is crucial because it's tied to the license, right? So it's not a maybe, it's a must-have. So this becomes an issue of control versus cost. And the cannabis premium sprung up during the land rush in almost every state, and it continues to linger. Often operators significantly overpaid for their locations to be the first mover. In many cases, that did not work out very well, and this cannabis premium exists to one extent or another in all states. And that is, in our view, a significant impact to what cannabis operators can or cannot do. It's of interesting note, National Association of Realtors this morning released a press release that the trend in cannabis sector is away from acquiring buildings and more toward leasing, which makes sense. If the capital markets are dry, you can't get the capital to buy the property, so your only option is leasing. So I will focus on that today in a great deal, but it doesn't eliminate the idea of purchasing, and we'll cover that topic as well. So in formulating the questions for this panel, we came across a big one, which is, and as I read it, you'll probably see that the answer is somewhat self-explanatory, but it really is, it does outline the dilemma that we face in cannabis. The current business environment for cannabis features 1, high facilities costs, 2, high financing costs, 3, intense competition from the black market, and 4, high 280E taxes. And it's hard to say which of those 4 are the worst. All of this in conjunction with falling and low wholesale prices in most states for cannabis flower. And so how much, this is first directed at you, Brian, and then we'll open up to the panel. So how much do these market conditions, how much distress do they cause on a national basis? And are you seeing different regional and or state by state variations of this distress?
Yeah, and that's an extremely important distinction to make when talking about this question. The amazing thing, but also the most challenging thing about the cannabis market and landscape for anyone in the audience that isn't intimately familiar with the market is just how hyper-local cannabis is as an industry and specifically for the real estate. You know, now we're on 38 states that have legalized programs between medical and recreational, and around 40,000 individual localities that are building the blueprint in your community for how cannabis will get regulated. These are being developed as local zoning codes, as building codes, and they're being developed by usually city councils, board of aldermen, city planning commissions, members of the community. So the learning curve is steep, and it's important to put the answer to your question and this topic, Peter, in that context, because whether there is great opportunity at one point in time or there is distress and consolidation, that too is pretty hyper-local. I think the headwinds and the challenges that you outlined for cannabis across the country are there, but it really depends at what point in the maturity and evolution of each state by state market, where the licensing process is, how many years that supply chain has been operating, whether it's commoditizing. Those all impact then obviously the operating statement and the balance sheet for cannabis operators who are ultimately either borrowers on their real estate or tenants servicing a lease. So definitely challenges in the industry. And I think our view is, as long as you underwrite and do your diligence on both the real estate project itself, so how those local codes, how the state licensing allows the property to be permitted and entitled, what you can do at that property now and in the future, and then simultaneously you underwrite your operating tenant that's either going into that as a borrower or a tenant. How are they going to navigate those challenges, those headwinds? You really importantly need to do those simultaneously more than any other industry in our experience. But it's so important to look at where the cannabis market is in its evolution in each of those local and state markets, to see and learn the lessons that the states that have already been there and done that can show you a bit of a crystal ball into what's coming. So I'll pause there because I'm sure there's plenty of input from other panelists.
Well, you raise a great point, and Robert, I'm going to ask you this question. I know currently you spend a lot of time in your underwriting looking at those local issues. You want to comment on how you view those local market conditions and of the property in each license?
Yeah, from a lending perspective, location of property, type of property, certainly has a big influence. I wouldn't call that a cannabis issue. I would call that a lending real estate issue. So oftentimes the type of property, what I'm referring to that is, in the world of lending, when you look to have a use of a facility, the type of use. So for instance, if it's a cannabis cultivation greenhouse, it is now designated for cannabis use, potentially could be a kale farm or, tomato farm if needs to be. But from a lending perspective, more uses allow for better loan to values, better lending opportunities from terms. Location, again, demographics of a particular location also do that. Again, not that we ever want to foreclose, but if we had to, we're looking at population of cities and locations, because then the number of potential secondary market investors and their ability to buy those properties are going to be a lot more, a lot higher in regards to in case of a resale. And then, of course, the last piece of it is the intended tenant users. Understanding the correct capitalization rate in regards to the lease and efforts that your overall payments are also covered. So I'm being generic without going too deep, but that's kind of covers that in a general. And again, I wouldn't call that a cannabis issue. I'd call that a general real estate lending information. So
true. But as we all know, the requirements of the CUP for most licenses are quite a bit more complex than your average barbershop. So Brad, are you seeing a move toward leasing versus buying in your business as the National Association of Realtor reports?
It really depends. I mean, what we're seeing right now in California, and again, Brian, I think that's a good point. It's hyper local, right? So a lot of these high financing costs, these black market competition taxes, I think are going to get worked out as this market matures and normalizes into a more, regular CPG market. And it's really about it depends. And I think the two winning strategies right now, especially in California, are: do you want to be a craft producer of super premium product that's not as sensitive to price compression? Or do you want to be a low-cost producer and make up some of the margin by, having a package of brands? So it really just depends. What we're seeing right now, what we really like, is some of the prepackaged sale leaseback stuff. So just in very simple terms, a lot of our clients and operators, will find a real estate investor to buy the real estate and then sign a reasonable lease for this specific market. So right now in California, we're seeing, 2 to 250 lease rates for cultivation, but, also being able to negotiate that option to give you a little bit more control over the real estate. And then the second piece is, sweetening the deal a little bit by giving them, maybe a piece of the wholesale action. But the key thing is right now it's about surviving, right? And in order to survive, you have to be able to, lower your cost of goods and then also improve your margins. So it's super important to be able to carve out, a distribution strategy to improve those margins, and equally as important, really controlling your relationship with your customer as this market normalizes into a more CPG format. So we could talk about this piece for hours, but we're all here for you guys to discuss specifics and help later on.
Great, thank you. Is any of the panel able to comment on the shift away from purchase to lease? Janet, have you seen a higher leasing activity with tenants?
Yes, thank you, Peter. What I've seen historically, particularly in the Western states, was a rush to take the easiest, less expensive perceived option of leasing the property at the commencement of the cannabis program. But after a few huge hiccups and rather predatory actions by certain landlords against tenants, the dispensary industry wakes up and says, oh, we've got to have control over our property. We can't put our property in jeopardy by having a default provision, for example, in the lease that is readily accessible and useful to a landlord. So what we saw was the movement away from leasing to purchasing real estate, particularly early in these states' marketplaces. When I mentioned earlier about these predatory landlords, what we found were that landlords felt they could seize the moment, capture the premium, the cannabis premium in their real estate by ousting a licensee who couldn't afford to pay rent, and then substituting in another cannabis licensee as tenant, and extracting a huge increase in rentals. There were also a few landlords who initiated eviction and foreclosure actions, and basically put the cannabis licensee at risk. So again, going back to what particularly Brad said, this is this being hyper connected to the site is a really important focus for any new cannabis industry participants, because without the location, there are no sales, there are no products to be produced, there are no plants to grow. And so what I think one of the items we have all not yet spoken to is the fact that any prospective tenant should be understanding and should be doing due diligence upon the landlord. Why? Because you want to see what the landlord's history is in dealing with defaulting tenants, for example. And you really want to have a good relationship, open and transparent, with the landlord if you're a cannabis tenant. Because sure, things happen. Maybe a machine breaks down, cuts your production capability, new taxes are imposed, whatever the issue is, you want to be able to have a good relationship with the landlord. So check landlords' port activities, determine whether there's a mortgage on the property, determine if there are restrictive covenants or any agreements, for example, conditions, covenants, and restrictions that might limit your capabilities in using the cannabis property.
Great. Thank you, Janet. Going back to the macro focus, most people on this call and have heard about failure of Silicon Valley Bank. In my view, that's had a massive impact on the lending environment all across the board, real estate loans, all sorts of loans. Robert, this is a question for you. Are cannabis interest rates going up? And a secondary question is, how is it impacted by the hyper locality in different markets, particularly the new markets versus the mature markets? Do banks take that into consideration, or are they just looking at collateral value?
Yeah, good question. So on a whole, what's going on right now is that a lot of the smaller regional banks have been now over leveraged due to liquidity requirements. I won't bank ease you guys to death here on how that all works, but and what's happening is then a lot of the local groups, private groups that are choosing to do lending, we're one of them, are now starting to see a quality of a borrower that they didn't used to get versus they were more what I call bank eligible, specifically moving forward, which is then what's happening is then it has a tendency to rise the overall rates specifically. For lending opportunities at this point. It does have a regional versus a national piece of it. You know, the type of product that we are offering to the industry has a national play to it, but from a banking perspective, rates have even gone up as well. Prime, as an example, yesterday just went from 7.75 to 8% as well. And then most lenders either lend on prime plus a margin or the new way we do it is called a SOFR rate, that plus also a margin as well. So it has unfortunately had that. I do know that there are individuals out there that are lending on a basis of where they're a high net worth individual. They might want to lend a couple of their own $1 million for a real estate loan. Those folks are probably still finding ranges that are realistically good, but the general, what I call institutional lenders, unfortunately, just due to that that little blip there right now, rates have unfortunately gone up as well. So well, that's great. I'm sure that we will see further impact as this thing sort of as awareness emerges as to how the markets are responding. My personal opinion is that the capital markets will tend to get tighter, as you notice, and people will begin to move towards private lenders as banks have to fold their cards. Are retail properties viewed differently than cultivation properties at this point by the lending community, Robert? 100% yes. So
more favorably, I'm guessing. Is that true?
Yes, it goes back to a little bit what I said earlier. It's what's called that alternative use. So if you buy a retail location and that retail location is eligible for cannabis due to zoning or opportunity or whatever it is, in theory, if that cannabis operator is uneligible to operate for all the reasons that you guys have mentioned so far, whatever happens, you could easily then put in a different type of tenant in that location. Versus cultivation facilities are very, it's called a special use facility is what the banking community, lending community calls it. And therefore, it doesn't have the impact as it did before just due to those facts. So a little plug for zone model. That's why I like the zone properties model because they obviously invest in real estate through the retail market specifically. So yes, so it's 100%. It's all about lenders on a general basis are always trying to mitigate risk. If you remember, a lender is not participating in any equity upside, no gross rents piece of it. There's not what we call mezzanine. It's a true lending product. So therefore, risk exposure is determined by understanding what might have happened and then what projective could happen. And then in case of everything goes to non-favorable terms, how they can get their money back. And often that comes from a sale of a property. And then obviously if that property has multiple uses of the property, then it allows for that exposure a lot differently in the way that it's looked at. So that was a maybe a little longer answer of why yes versus retail versus cultivation, but yes.
No, that's good. Thank you. And let me take a moment. Hold on. I'll get back to you, Brad, in a second. Let me take a moment to remind the listeners that we will be taking questions at the end, but you can ask questions now, and please, if you have them, put them in the chat, and if they're pertinent, we'll answer them now. But we'll spend about the last 10 minutes answering any questions you may have. So, Brad.
Yeah, just going back to Brian's point in the very beginning, it is hyper local, and it depends. So location being in Southern California, specializing in indoor cannabis cultivation, these are just simply industrial warehouses. And SoCal industrial warehouses is one of the hottest asset classes in the country right now. So we're seeing very favorable rates from some of our lenders focused on industrial real estate, and in most cases, the industrial backstop is higher than the cannabis use because of the onshoring and some of the macroeconomic trends coming from things like the Ukraine war and onshoring from China. So I just wanted to give a little bit more detail about what's happening here in SoCal.
Yeah, I'm gonna echo what Brad said. So he was making a point I thought was crucial, is that he really just identified location, what I said, Southern California, right?
Mm-hmm.
Second, he just mentioned industrial properties. To his point, is a high and best use right now. Lenders are loving that type of use, and then it can be applied to cannabis. So Brad's exactly correct. So just keep in point, we were saying the same thing. He just mentioned that property type just is a difference. So thank you, Brad. That was great.
Does the same dynamic hold true for, say, Detroit or New Jersey City for industrial properties?
Again, if it is, Detroit is also just fine. Like you said, if it's a high population city in New Jersey, it's also just fine. It goes back to that participation location. So, if it's a higher population area, lenders are always going to like it more because more individuals, more people to be able to do that. It's just about mitigating the risk, knock on wood, if there's a foreclosure. So to his point, nationally, industrial properties are a really hot ticket, take cannabis aside, but because it can have other uses outside of that specific use. So Brad touched on that really well on that piece of it, which is why that falls in line.
All right, great. So I think everybody on this call understands that there are mature markets and there are markets opening up. The growth is focused on those new markets, and so they have different dynamics. Yeah, price compression hasn't kicked in and so forth. So I wanted to pivot a little bit and talk about the mature markets versus the new markets in terms of companies setting up their operations. And if the National Association of Realtors report continues, it means that more and more operators will favor leasing versus acquisitions. And so then the question, this is really for Janet, a legal question, then anybody can dive in. What lessons can be learned from the mature markets that can be transferred and adopted by tenants in the new markets in terms of provisions in their lease and examples like due diligence they should be performing and other things they can do to control their real estate?
Thanks, Peter. Well, I earlier spoke about due diligence on the landlord. I think in most cases in a new marketplace for cannabis, prospective licensees do not look at the backgrounds of their prospective landlords. And so I really encourage you to understand that the dynamics in that relationship. Additionally, I think one of the really key provisions in a cannabis lease that protects a tenant client would be the assignment provisions. What you are doing with respect to assignment provisions is providing yourself with flexibility. So, for example, you may not assume that in the near term, you're going to want to sell your business to a new licensee, in which case you would likely need to get the landlord's approval. Well, you may not want to do that today, but in the near term, if you do, say you realize a great uptick in your market and your market share, and you do want to sell your business, you need to have the right to make an assignment of the lease. That's a transfer of the lease of your tenant's leasehold interests to a successor. And what you need to insist upon with in negotiations with your landlord are minimal parameters for landlord's approval of that transfer or assignment. Some landlords will want a serious number of hurdles for your buyer, for example, to work through. For example, the buyer needs to have the financial requirements that the tenant did in getting into the lease, or the buyer must have competent industrial experience, marketplace experience before the transfer would be approved. Additionally, some tenants want to collateralize their leasehold interests by pledging that lease as and the tenant's lease rights as collateral for a loan. And you, again, if you're a tenant, you want to have minimal restrictions on that. You might also, in your due diligence, find that the landlord has mortgaged the real estate, the property. And so you might want to insist upon getting a subordination, attornment, and non-disturb agreement that you, the tenant, as well as the landlord and the landlord's lender enter into. Why is that important? That SNDA protects a tenant's rights to the leasehold and the lease provisions in the event of a foreclosure. And there are numerous other lease provisions that could be interpreted and written pro-tenant or pro-landlord, which are typically adverse.
Great, thank you. This is a general question for the panel. If you are a tenant, an operator looking to become a tenant in a property, what are some of the top things you can offer or demonstrate to a landlord to give you the best possible lease rate, to show that you are the most creditworthy and that you're a good risk and you're going to be a good tenant, you're not going to default, you're not going to destroy the property? What are some? Is it the length in business? Is it the strength of your financials? Is it the guarantors? Is it the license? Give me some insights on what landlords are looking for in terms of a quality tenant.
If I may answer again,
Sure.
Cut out the other guys. What I think is growing across the country is an interest by landlords in taking collateral under a UCC filing and/or a real estate recording, if appropriate, in the cannabis license or licenses. Some states prohibit this. Some states don't have a clue yet as to whether this should or should not be available. But ultimately, in most cases, the licensee's top asset is the license. And so in addition to a landlord's lien, which most states impose upon the personal property of the tenant when rent is due, landlords are suggested to inquire whether the license could be available as collateral to secure performance under the lease. Brian's probably going to go, no, we don't do that, but.
Well, I think this is for the audience. This is a healthy, constructive debate Jan and I have been having over the years. So for context, at Zoned Properties, we are both service providers. So we are consultants, we are commercial real estate brokers. We provide those to third-party clients across the country. We worked on hundreds and hundreds of deals and negotiations, but we're also an investor and acquirer of property where we are the landlord. And I think the position at this point in time, and we've gone back and forth on this over the years, but until there is federal reform, I think our position and our advice to our clients and our position as a landlord ourselves is that we want to draw as strong a barrier as possible between the plant touching side of the business and the asset ownership, collect my rent check side of the business. So at this point in time, to tie, I think, the whole discussion up to this point together, and Robert, you said it earlier, this is a collaborative venture that tenant and landlord and investor go through to create the highest and best use for a real estate project, make sure that that highest and best use can be maintained, because that unique use as a cannabis site is what gives it its highest value, gives it its premium for an operator to create cash flow and profit from, and gives it a premium for lease rates, which we can come back to. But the thing we see constantly, and why Janet's comments are so valuable that you just made, Janet, the thing we see that kills and hurts deals time and time again is inexperience. So not having the right attorney, the right broker, the right banker, the right developer, especially on cultivation. Most deals die because there's a development problem. So inexperience and greed. So one side, the landlord or the tenant, is unreasonably greedy. They want a rate that's not sustainable, or the tenant wants terms that are unreasonable to ask of a landlord given the risk. And those either kill the negotiation, or the parties in a disgruntled manner sign on to that deal, and then there's a default problem in the years to come. So yeah, I think it's really critical. The goal in all of this for finding, developing, and delivering successful real estate in cannabis is finding the right ratio in your deal formula and making sure you have experienced experts within your company or contractors to bring onto your team that know the labyrinth you're about to go through.
Yeah, maybe I'll just add to that too. You know, some of the the deals that we've done with landlords for our clients, it comes back down to the basics. It's, you know, the landlords are looking for money, they're looking for credit, and they're looking for like a developer or a team that can actually execute on their project. And really, it's the cannabis entrepreneur's main job to build that A team to execute around that money, that credit, and being able to execute. And a lot of the times, especially here in California, these landlords realize that, you know, the tenants or the cannabis entrepreneur's worst case is in most cases their best case, because when they're investing $200, $250 a square foot in construction, and they put, you know, $5, $6, $7 million into a building, and the landlord gets it back, you know, the rents go up substantially and they have a pretty nice asset.
So to rephrase, Brad, if the tenant is going to put in significant tenant improvements, those tenant improvements are, in a word, a security deposit from the landlord perspective.
Yeah, they're massively improving their property for, you know, multiple uses. And again, going back to a previous, you know, part in the discussion, is that the underlying asset is industrial real estate as well. So, and
Robert,
I'm speaking specifically from indoor cannabis cultivation, greenhouse, and some of the other stuff is separate.
Robert, from a lender perspective, do lenders view tenants installing large-scale TIs on their own dime? Does that increase their creditworthiness, and does that give bankers more comfort that the asset is going to be stable?
Yeah, I'm going to answer that question plus comment on another one. So I'm going to comment on another one first. You guys were talking about the leases specifically, and in regards to, you were talking about the earlier in regards to the recording of those leases. I want to always bring up that one of the folks that, you know, it's pretty common to record a lease on title. The part that I find that sometimes that landlords don't always realize that if you're going to get a loan, then you're usually going to request those leases to be subordinated to the lender. So that's one little topic that I feel like sometimes people miss. Second is that even if the subordination agreement is that a lot of the times those leases also have what's called an assignment of rents. And again, I'm not the attorney, so I want to be careful in how I say this. But at the same time, from a lending perspective, I guess I just want to make sure you guys understand that in case there's a default as well. To answer the question, the direct question you asked me in regards to the actual part of it, yes. So if a real estate loan is going to be put in place, improvements to a property are certainly put into it. Whenever somebody looks at an appraisal perspective, they're looking at what they bought the property for, what intentional capital improvements have been made, either if that was the landlord or the tenant, and then those are then referenced usually through a formal appraisal, and then those assessments ultimately end up deciding value of the property itself. So yes, it does certainly help. Where it can be a little bit of a cross is what I call cannabis specific improvements and what are just general improvements. So as you know, this industry, and I'm referring to indoor cultivation, HVAC and chillers, HVAC itself, of course, has an overall internal, could have multiple different uses, but the HVACs, as you know, have a more abundant use in an indoor cultivation. And then of course, chillers are very specific to the industry. So just a matter of understanding the specific capital improvements, what they were for, how they were used, and then it ends up going to the overall value. What's hard sometimes when you see a property that was purchased for $2 million 3 years ago, and suddenly tomorrow after $3 million improvements, it's worth $15 million. So just keeping that in perspective of that as well from an overall use. So hopefully that answered that question for you, Peter.
Yeah, let me paraphrase. What you're saying is that from a lender perspective, if the improvements support a general use, a retenanting to the general industrial population, it adds accretive value to the lender perspective. But if it's cannabis specific and the market moves away from cannabis in that area, perhaps not.
Yes, that's true. As I mentioned, we're obviously focusing on cannabis today, which is great, but I'm also trying to somewhat prepare the cannabis community for what the banking community is going to look at these properties. Private lenders that are choosing to invest in the cannabis industry certainly give what I call more credence, oftentimes, to cannabis specific improvements. But I'll tell you, as one day, we all know it's going to happen, move to more of a federal regulation that's going to be all something we've been wanting to have, then the banking community is going to look at it just the way I mentioned as well. And I'm just trying to help the industry get prepared. So as they go to non-high interest rate lending, bridge lenders, and they move to more banking lenders as those opportunities, so they can kind of see how the banks are going to look at that as well. So that was where that intent of that comment was.
All right, thanks, Robert. Just a heads up to the panel, we've got about 10 minutes left in this session, and we do have a couple of questions. Are there any? Before we get to the questions from the attendees, Robert, I have another banking related question, and anybody can answer. And when you're underwriting a loan, how much emphasis do the lenders put on the resumes and the team of the borrower? And specifically, we've all seen fancy pitch decks, but specifically, what type of how deep a description of experience and accomplishments and past work history of the team is important for any borrower to highlight?
Yeah, so from a lending perspective, in a cultivation facility, anything else, there's usually a couple different bios you're looking for, right? You're looking for someone that has what I call construction management development experience. So like if Brad was on their team, I would love it, right? As an example, because he would have all the experience. It would make me feel comfortable from a lending perspective. And then I would go to someone like Brian, I would love, because he has direct management experience of managing the properties once they've been built. So those two bios would be great from a lending piece of it.
Well, let's not leave out legal. If they also had Janet on the legal team, would that be an all-star team?
I was getting there. So, and then of course the other part of it is just showing how they structured their lease. So if their lease was structured in such a way that had all the compliance, and I mean, I'm literally going through a transaction right now where they did not have, let's call it Zuber law, and their tenant lease was completely messed up. And I had to work with the attorney to show him how to fix it. So, and therefore it did a lot of clouds on the title. So, with that being said, is that those are all important aspects of lending. And then what I call is then the last part of it is the business acumen. So you need to have business acumen. And if you don't have business acumen specific in this industry, then you must have somebody on your team that has the business acumen, what I call the technical expertise. So if you're been a long time cultivator, I don't care if it was black market 20 years ago. It's more just that you have experience in running these large facilities. So it's business acumen, technical aspect, property management piece of it, and then also that those are all crucial parts in regards to lending, and it also goes to the credit worthiness. Now, all of those parties do not need to be the borrower, but they need to be able to show that they have those specific groups as tied to them. So when I look at bios, those are specific things I'm looking for as well in the lending.
Oh, that's very helpful. Thank you, Robert.
Mhm.
So let's pivot and focus on the questions from our audience. And a couple questions from Ted Kelly. So I think I understand these questions. The general question is, how constrained is the capital market because we don't have federal banking reform? And I'll give a quick answer and then open it to the panel. Significant. As we've seen, the banks are happy to have your deposits and charge you a nice fee to take your money, but are loath to lend you money. So I would say that at the federal level, the whole idea of recycling deposits back into the local community as loans isn't happening. Panel?
Yeah, I
Anybody
might
want
just
to?
add the general phase we're at in kind of maybe the third wave of cannabis evolution. And we've seen these cycles in the past at smaller variables, but the drying up of equity then significantly impacts the demand for debt. And this all ties back to the real estate. One of the reasons I'm sure we see a huge shift from borrowing and acquisition to leasing is just the dynamic by which it's difficult and possible to get direct debt versus viewing your lease as an interest-only loan. And then instead of owning the building, the trade-off is you don't have to pay off the principal at the end. So, I mean, that's a huge factor in the difficulty of where capital markets are in general. And our sense, especially as a public company, so we're talking to investors all the time, our sense is essentially that there are a huge number of cash position investors sitting on the side of the pool, either just dipping their toes in, trying to find the right groups to invest with, or they are waiting for a long overpromised federal catalyst, or at least that is the excuse until they see a decrease of turbulence in the marketplace and an increase of financial health of a lot of the operators.
Great. Thanks, Brian. Also a question by Ted Kelly, and I think I understand the question. Let me paraphrase it. He's talking about how loans get complicated if cash is involved. I'm not quite certain which counterparty he's talking about, but is it difficult to repay a loan? As we know, a lot of retailers and cultivators get paid in cash. How difficult is it to pay your bank your loan payments in cash? And does that screw things up from the lender's perspective?
I can answer that. I will tell you, if you don't have a depository relationship with some financial institution, banks will not lend to you. So you must have like I said, we want certainly federal reform to happen, but there are certainly regional pockets of credit unions and banks that are willing, to your point, take on the depositor relationship. So I would hope that that depository piece is certainly not as solved as we want it to be, but certainly should be allowed. So therefore electronic payments should be available, and therefore to be able to review it, because financials are often reviewed compared to the bank statements. And then obviously if you don't have a bank statement, then you can't review that in relation to that. So I would encourage folks, as I mentioned, I haven't seen a state yet that hasn't popped up a local credit union at a minimum that's willing to take on depository relationships.
And Robert, for scope of size here, I think you and I were just talking about this. There's what, maybe 500 to 600 banking institutions nationally that will currently, or at least have in the past few years, been open to cannabis clients. Is that a fair number?
Yeah, like I said, I personally, coming from the banking community, I personally have 90 banks and 300 credit unions that are banking this industry now. And they're under the premise that they've gone through their review with all the regulations, and they have a certain asset amount that they're not allowed to go over. There's a certain, I mean, again, I won't bankies you guys to death on why that is, but there is more than enough options at this current point for the market. Yes. Do we all want federal reform? Yes. Do we want banking to be legal nationwide? Yes. But honestly, what that's really going to do is just allow for what I call Chase, Bank of America, to really get in. The smaller regional groups are already in. So
Great. We've got about 4 minutes left. There's I was anticipating this question, and Robert Miller in the audience provided it. And it's basically the question, the $64 question, what interest rates are available today? And let me answer that, and then I'll pass it along. Well, it depends, right? It depends on your creditworthiness. It depends on the project, depends on the location. I've seen rates from 10 to 18%, depending. And also, if you want a 6-month bridge loan, then and you have a takeout loan, you know, maybe it's 16%, and you don't worry about it because you can get the job done quick. Robert, anybody you want to jump on that?
Sure. I'll, just from like another macro perspective with the industry, there's stuff happening outside of cannabis, like the rate hikes, but then also inside of cannabis, like super low wholesale pricing, which will improve. And I think as a whole, what we're seeing is, savvy California operators, they're not paying the premiums anymore. They just can't afford it. So, I agree, Peter. I'm seeing ranges between 10 and 18%, but now it's getting closer to 10, to the low teens and the 10. Which is interesting because as rates go up, in the macro, at least from a cannabis real estate perspective, the cannabis real estate rates are actually going down.
Interesting.
Yeah, I can give just a real world example quickly and then pass it to Robert. So we closed around a $5 million loan directly with a bank in December at the end of the year. Of course, rates in general are fluctuating, but we fixed at 7.65% on a 10-year swap structure. So of course, I think that's just about the most competitive you're going to be able to get. We were able to get that because of years of relationships with banks, because of the fact that we've been in this space for a decade. We had well-performing history of operating real estate, and specifically the reason I want to give this example to the audience, huge difference if you are a plant touching borrower or a non-plant touching. So if you are just on the real estate side and your leases are structured correctly, almost certainly you're going to be able to get several points better than if you are a plant touching business of any size, which is another big reason to structure a lease versus borrowing and acquiring.
Understood. Well, I think that's a great moment to wrap this up. There's no new questions in chat. The panelists, you've been great. Thank you very much. One last message I'd like to give to the audience, and that is, whether you're struggling to pay your existing rent under a lousy lease, or you're looking to find a new location, please reach out to us. We are here to help. We have years of decades of experience in helping you get a deal done. And with that, I want to thank all of you for attending today and for all your efforts. And I want to thank the audience for staying to the end. Any last thoughts?
thank you. Yes.
All right. Well, listen, thanks very much. And we'll see you again next time.
Bye.